What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. This episode was released early to premium subscribers last week, and it features someone who truly needs no introduction. But for those of you who may not know Mohamed El-Erian, he is the president of Queen's College, Cambridge, and chief economic advisor at Allianz, the corporate parent of PIMCO, where Mohamed was CEO and co-chief investment officer from 2007 to 2014. Mohamed is a remarkably gifted communicator who is intimately connected to the global policymaking community. And this makes him uniquely valuable to speak to during a time when the prospect of a policy failure is arguably the single biggest risk factor facing markets and the global economy. I asked Mohamed to appear on the podcast today because I believe that we are entering a very dangerous period in financial markets. As investors, we've all been conditioned to believe that markets always go up, that dips are always meant to be bought, and that when things don't work out, central banks are here to bail us out. But in a world where inflation is persistent and policymakers around the world have begun raising rates and contracting credit, continuing to bet on mean reversion could prove to be a deadly strategy for investors. My objective in this conversation is to give you a framework that you can use to navigate a world that is transitioning from one of insufficient demand to insufficient supply, from historically low volatility to rising uncertainty, and from easy money to hard choices. This is true not only for central bankers, but also for investors like you and me. Subscribers to our Super Nerd tier can access the transcript to this episode as well as the Intelligence Report, which is the cliff notes to the Hidden Forces podcast, formatted for easy reading of episode highlights with answers to key questions, quotes from reference material, and links to all relevant information, books, articles, etc., used by me to prepare for this conversation. Since this episode deals with markets and investing, I want to make it absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this deeply enlightening conversation with my guest, Mohamed El-Erian. So, Mohamed, it's great to have you on the podcast. You've been one of the more outspoken critics of the Fed in recent months. You've made the case for more hawkish forward guidance and also tighter monetary policy. What would you say are the risk factors that most concern you and that markets in the economy are grappling with right now? And how do those risks relate to the Federal Reserve's current stance on monetary policy and inflation?
So my major concern is that we are witnessing a big policy mistake. We are in phase 3 of this policy mistake, and that policy mistake will unduly harm the economy, undermine livelihoods, and then also disrupt the market that could then have a negative spillback effect onto the economy. So if you step back and think of what would happen to our economic recovery, it would be undermined not by private sector developments, not by the end of a cycle, but by the Fed being too late in taking its foot off the accelerator and instead having to hit the brakes very hard.
So I'd love to go into that in more detail, specifically this idea of a policy mistake. What exactly do you think the Fed has gotten wrong here?
So 3 stages of this policy mistake. Stage number 1 goes back to 2020, when for understandable reasons, they decided to adopt a new policy framework. The problem is that the policy framework they adopted was made for the world of yesterday, not the world of today. The world of yesterday was insufficient demand. The world of today is insufficient supply. So mistake number one is adopting a framework change at the wrong time that told the markets that they would be looking backwards, not forward, in trying to contain inflation. Step number two, which was a much more obvious mistake, and many of us have warned against it, is that as early as March of last year, they decided to characterize the higher inflation as transitory, and they did not, quote, retire that characterization until the end of November, when there was ample evidence, both from the companies and from the economic data, that inflation was not transitory. Mistake number three is what's happening today. By not moving early enough, they're going to be forced into a very hard pivot. They will bunch three sets of contractionary measures, and the risk is that this economy could not navigate through these three contractionary measures.
So I'd like to explore that more, Mohamed, but you're so good at, I think, you're one of the best in the industry at really creating metaphors or mental frameworks that help people think about where we find ourselves on a big picture level. You did it in 2009 with the, quote, new normal hypothesis, that we were moving into a regime of secular stagnation driven by structural impediments to growth. You did it again in how you described central banks as the, quote, only game in town, which I think really captured the significance that central bank policy was going to play in informing the direction of markets and the, I think, decision-making framework for investors at the time. I'd love to take a step back here and understand what your framework is for where we are moving in today. You talked about insufficient supply versus insufficient demand, which was the issue during the stagnationary period. How would you describe where we find ourselves today, and what do you think are the key factors responsible for that?
So I think if you were to look for the bumper sticker, we've entered in a world not just of insufficient supply, and that relates not just to the supply of goods and services, but also to the supply of labor, but also in a world in which we have either pressed pause or reverse on globalization. And that in itself has an additional set of consequences for the global economy. I think the first element, insufficient supply, we live it every day. It's harder to get things. It takes longer to ship things around the world. It's become much more expensive. Oil has become much more expensive. Energy is more expensive. Gas is more expensive. And then there are labor shortages. I think all of us are exposed to these labor shortages. So we know what that world looks like. And there are certain aspects that are good about it, which is higher wages, and in particular, higher wages for the less well-paid, and that is good. But it is also inflationary more broadly. The second element we don't see as much, but it is consequential. For a long time, we were living in a disinflationary world. And the way I describe this is just think of what Amazon, Google, and Uber have allowed us to do. And I'm just using these as labels. Amazon cuts out the middle person. So it provides us with lower cost. Google allows us to price search. We are less price takers and we are more price setters. And then Uber, perhaps the least well understood effect, but the most powerful, allows us to use existing assets to deal with supply problems. Those three things were very powerful, and they played it out for over a decade in causing disinflationary wins. Now we have a very strong counter force, which is the fragmentation of the global economy. If you're Australia and you've been doing business with China, you know what that feels like. Suddenly, the Chinese economy is no longer available to you, both on terms of selling things and important things. We are seeing more regionalization, the emergence of blocks as opposed to globalization, and we are seeing very weak multilateral institutions. A perfect example of that, of how we are exposed to this, is vaccine inequality. Delta originated in India. Omicron originated in South Africa. And in both cases, the global system had failed to provide sufficient vaccination. We thought we were fine because we were highly vaccinated, but it turns out we are vulnerable to the parts of the world that are not. So we have to learn to live with a world that is more fragmented and where spillover effects are more pronounced.
Is that another way of saying that you think that we're moving from a more open world to a more closed world?
From a world that assumed openness was almost a given to one in which we are much less open, yes. I don't want to say closed because I don't think any economy other than maybe North Korea can live in a closed global economy, but certainly less open.
Right. And I mean, another way of thinking about this obviously is that geopolitical tensions have been rising. And I wonder why markets don't seem to have reacted to rising geopolitical tensions over the last several years the way that one would have expected them to if you had polled an investor 10 or 20 years ago. Why do you think that is?
I think there's two elements. One, long-standing, and the other one is more recent. Long-standing, it's very difficult to price bimodal distribution. Look at what's happening in Russia and Ukraine today. It's either going to end up open conflict or it's going to end up diplomatic resolution. It's very difficult to be confident about one outcome. So you end up in a muddled middle. You price neither outcomes. You price some average of the two that is least likely to materialize. But there's something else recently. And let me take you to the investment committee, to a typical investment committee in a sophisticated investment management company. You present a case for buying a certain bond, stock, whatever. And we go through all the fundamentals. Is it financially resilient? Is it well managed? Does it have a good market in front of it? And you convince us all that the fundamentals are a green light. You will be asked a very important question. Who's going to buy after us? The subsequent buyer does two things that are very important for an investment. One, they validate your investment. Think of you buying an apartment. The minute you close on that apartment, what you really want is 10 people bidding for the apartment next door because the value of your apartment is going to go up. So the subsequent buyer validates your own purchase. But the subsequent buyer does something else as well. They provide you liquidity if you have to change your mind. Now, I come along and I tell you, your subsequent buyer is a central bank. It is the Federal Reserve. It has a massive balance sheet. It has seemingly an infinite willingness to use it. And one more thing, it is price insensitive. It is not a commercial participant. It will buy regardless, and it will turn up every single month with massive purchases. If I tell you that, and you believe it because you've seen it now month after month, you will buy ahead of this. And whenever you see a geopolitical shock causing some pullback in asset prices, you will know that there's a big buyer out there. And it doesn't matter that they're buying just government bonds and mortgages because it ripples through the whole system. So the second reason why markets have been immune from geopolitical risk, in fact, from almost any shock, is there was a confidence that the Federal Reserve was our best friend forever. And don't underestimate how powerful that phenomenon was. That's why you hear consistently buy the dip, TINA, there is no alternative, and FOMO, fear of missing out.
Okay, this is great because I do want to ask you about this, and we'll probably pivot again later back into geopolitics because I do want to ask you how you think the move towards a more multipolar world that we are currently living through will impact the decisions of governments to, let's say, for example, one good example is in Europe, consider trade-offs between security and the welfare state. But in terms of the Fed, this is really fascinating because one of the questions I wanted to ask you is how does someone like you factor in things like behavioral conditioning or risk tolerance that change structurally as a result of the types of dynamics that you've described here, the reinforcement of buy the dip, and also the fact that investors now for years have become conditioned to this, not just because of the Federal Reserve, but because of the historical empirical data that has shown convincingly that investors are better off being in the market and not selling, just using opportunities to buy. How do you think about that going forward if one of the major sort of legs under that stool gets taken out?
So I'm a great behavior in the power of behavioral science in understanding outcomes. It doesn't explain everything, but it sheds that extra bit of insight that's really important. And we're coming from a period in which investors have been deeply conditioned to buy the dip. And they've had consistent confirmation that that is the right thing to do. There is a reason why that is happening. It's very visible. It's called the Federal Reserve injecting as much as 120 billion of liquidity each month into the marketplace. It has been reinforced by experience. And because of that, a couple of things happened. The dips became smaller in duration and in magnitude. And that was critical. And two, because of that, volatility came down. And when volatility comes down, there are models that encourage people to put more money at risk because the volatility of your investment is lower. So you've had this reinforcing behavioral and structural technical playing out. And the result of that were 3 incredible years of returns. To think that we've had 20% basically average returns for the last 3 years, while we've had COVID, geopolitical problems, all sorts of other issues, is incredible. But it is explained by this mix of not only liquidity, but behavioral aspects. Now, behavioral aspects are really difficult to predict, but you've got to keep on looking every single day. In the marketplace, the biggest change in behavioral aspects was when the marketplace goes from thinking in relative terms to thinking in absolute terms. You know, there's this famous story of someone who comes home with a dog and declares to his family proudly that he paid $40,000 for this dog. And the family looks and says, "You did what?" And the response, he says, "Yes, it was a great deal. The cat was selling for $50,000. That is what's called a relative mindset. You continue buying not because what you're buying has value in itself, but it has value relative to other assets. And that can go on for a very long time. So when the Federal Reserve takes down and makes it onerous to hold bonds, you are pushed into taking more and more risk. And that works great. At some point, you get the pivot from relative to absolute. At some point, someone says, is a dog worth $40,000? And there is a wake-up call for everybody. I grew up in emerging markets. I cannot tell you the amount of times I've seen this regime shift. And they are violent when they occur. So it is very difficult to predict when this regime shift will happen. The good news is when it does happen, if you understand it quickly enough, you have time to get back on side.
So again, a lot of really great points. I want to try to pull them out and address them each individually. The first has to do with investor expectations and how these expectations have been shaped by the reassuring posture of central banks who have stood ready to, quote, buy the dip and provide the liquidity necessary to both elongate the bull market and perhaps more consequentially for the purposes of credit and leverage, reduce volatility. Do you think that this conditioning has made markets more resistant to embracing this new regime of insufficient supply, spotty liquidity, et cetera, that you think we're moving into? And if so, what does that mean for the type of volatility that we should be prepared to see once markets try and readjust? That's my first question. And then maybe the more broader question here is, Why do you think the Fed, if you agree with this, the Fed and other central banks didn't accurately factor into their tightening cycle the risks to financial instability, that they were focused very much on employment and on inflation, but they were maybe not taking enough account of the more difficult things to measure, like capital misallocation or unsustainable business practices?
So let me suggest on your second question first, if I may, on your second question, that it's the other way around. That it is because the Federal Reserve was so worried about financial instability that it ended up with a pedal to the metal approach when the economy would have called for something else. Let's take the fourth quarter of 2018. A relatively new Federal Reserve chair comes in, recognizes that the Fed had been co-opted by markets, recognizes there's a ton of moral hazard that had built in, recognizes there was an unhealthy codependency between the Fed and the markets, and in the fourth quarter starts signaling that the Fed was going to tighten policies consistent with economic developments. If you remember, at that time, the economy was doing extremely well. Markets were just fine. Liquidity was abundant. Markets have their second taper tantrum. The first one was in 2013, May, June. They had their second one. This one plays out in the equity market in a big way. And come the beginning of January 2019, Chair Powell undertakes a massive U-turn that is not warranted by economic developments. It was in response to financial instability. Now, if you are charitable, you would say, well, of course, it's related to economic fundamentals because at some point, the financial instability would spill back onto the economy. If you are less charitable, you would say it is yet another time that the Federal Reserve has proved that the Fed put is alive. That the minute the market is uncomfortable, is volatile, the Fed will have no choice but to be pulled back in. And that is, if you like, people trace that all the way back to 18 years ago, to this conditioning of the market that there was a Fed put. In fact, the last period of instability, a lot of the narrative was in terms of where is the Fed put? Where is the Fed put? Is it minus 10% on the S&P? Is it minus 20% on the S&P? So I would say to you, the problem is that the Fed became so sensitive to financial markets that it put that ahead of other things. It's a little bit like you fall into the trap of providing candy to your child. You recognize that you've provided too much candy. You try to stop. Your child has a tantrum. You decide that the consequences of the tantrum are not something that you want to live with, and you give more candy, even though you know that that is not a good long-term solution. That is where the Fed got stuck in, and it worked as long as there was no inflation. Now that there's inflation, the Fed cannot do that anymore, and that's what the market is recognizing. Look, I am one who have said, no matter what you think of fundamentals, you should continue riding the liquidity wave. I've said this over and over again the whole of last year. I remember Leon Cooperman, a very famous and respected hedge fund manager, saying on TV that he was really worried about the markets. And then he was asked, how are you positioned? And his answer was, I'm a fully invested bear. Yes, I'm a bear, but I'm fully invested because it's liquidity right now that is governing outcomes, not valuations. So people will ride that. Let me give you one last example, if I may. At the end of 2007, a CEO of a major US bank came to see me. And I asked him, where are we in the market cycle? And he drew an upside down U. And I said, where are we? He said, very near the top. And I said, how are you positioned? And he said, maximum risk on. And I said, how can you be maximum risk on if you're near the top? He said, Mohamed, it's very simple. Number one, everybody else is maximum risk on. Number two is I don't know where the top is exactly. And number three is I'm confident I can reposition myself once there is unambiguous evidence. I remember that phrase, unambiguous evidence that we've turned. His bank had to be saved by the US government. So there is an inclination to ride these liquidity waves right till the end because the cost of premature exit is perceived to be quite high, especially when you judge on short-term performance.
So again, lots of really interesting threads to pull on here. Just with respect to this observation about both the fundamental unpredictability of markets, the difficulty, in other words, of timing a top, and the herd behavior and conditioning of investors to chase momentum late into a cycle, how would you say that investors are set up going into this top, wherever it might be, and maybe you think we've already hit it?
So it's still that very few people are comfortable taking on the momentum trade. And that's why we have seen equities recover, even though inflation is 7%. That is why we have seen equities do well, even though the yield curve has been flattening, signaling an increased possibility of a policy mistake. And what the other thing people have discovered is that we lack inherent liquidity. If I had said to you a few years ago that a widely owned name that is deemed to be highly liquid in the marketplace could be down 25% in a few hours, you could wipe 250 billion off a market valuation, you would have said that's really unlikely unless this company is defaulting. Well, that's what happened to Meta, to Facebook. I was talking to someone who told me that they had difficulty trading Microsoft, that when the paradigm changes at that moment, there isn't risk absorption in the system. And that tells you two things. One is many people are on one side of that trade, a trade that has worked extremely well. And by the way, it has continued to work relatively well. The losses of January, while notable, were nothing compared to the gains of the last few years. It tells you that it's still a very crowded trade, but it also tells you that there's structural illiquidity in the system. And that makes sense because since the financial crisis of 2008, we have shrunk by regulation the intermediaries, and we have increased significantly the end users, the non-banks. The ratio of non-banks to banks has gone up enormously. Now, the non-banks can't trade among each other very easily at all. They have to go through the banks. So when they want to reposition in a major way, there simply isn't enough risk absorption to allow that to happen without massive moves in prices. You've seen that with Amazon, you've seen that with Facebook, Meta, but we've also seen it with Snap, up 62%, right? And I think we have to get used to the fact that when the liquidity goes out, we are going to have a lot more volatility, not just single name, but because of ETFs, also for indices as a whole.
Okay, so that actually raises two questions. The first question is, if we assume that the Fed has lost control of the inflation narrative and that inflation is in fact going to be sticky, it's going to be persistent, does that almost guarantee that the Fed has to hike us into a recession? And given your observations about liquidity, what does that mean for asset prices? And two, what guarantees do we have that the Fed would even be able to do anything about inflation, since many of the sources of inflation this time around are supply-driven and in some ways out of the Fed's control?
So those of us who lived through the 70s, and I was just learning economics at university, remember what an inflation dynamic looks like. Younger people haven't lived through it. An inflation dynamic starts with a major disruption somewhere. In the 70s, it was the oil price increase. Today, it was supply disruptions, labor shortage. It's very localized. It's lumber prices, you will hear. And then next thing you know, it starts to be very broadly driven. It starts to be more persistent. And the reason why is if you're not careful, what is a reversible and temporary shock changes behavior. And that's why a lot of us, actually a few of us, as early as April last year, was urging the Fed to be open-minded. Don't call it transitory because you don't know. Have some humility. And what we've seen happen is that the shock may well have started in a certain place, lumber, chips. Next thing you know, it starts disrupting supply chains. It spreads. That's phase one of an inflation process. Phase two is what's called adaptive expectations, and we are seeing it today. Is people realize they've been hit in real terms, and they want to compensate. Companies start passing on prices to their final consumer without any hesitation whatsoever. And then wage earners start requesting higher wages. That's exactly what has been playing out. Phase three is the most dangerous one. It is when the expectation formation is not just adaptive, you're not just trying to compensate for past inflation, but becomes anticipatory. You start wanting to compensate for future inflation. At its extreme, and I'm not saying we're going anywhere near that, we're not going back to the levels of the 70s, even though we are following the dynamics of the 70s. At its extreme, it becomes hyperinflation. Now, the Federal Reserve cannot deal with the first shock, but it can deal with what happens thereafter. This Fed had the wrong framework, part one of the mistake, got stuck in a transitory characterization of inflation, part two of the mistake, and part three, it failed to move when it could move. You can go back, and I and others were urging the Fed to slowly take its foot off the accelerator by reducing QE last summer, because what we wanted to avoid is what's going to happen now, is that the Fed is going to be forced into a bunching of three contractionary measures. And that threatens the economy in a way that was avoidable. It will end its asset purchases. It should have already done that a while ago. It will start raising interest rates, and it will look to reduce its 9 trillion bloated balance sheet. And that is why we are now in the world of third or fourth best. The first best approach was to start early, go slowly, and make sure that the economy can accommodate. Now, the Fed is going to be forced into a major pivot, and we don't know what the consequences of that pivot is going to be. The marketplace is pushing it to increase interest rates at least 5 times in 2022. I would have never called for 5 interest rate hikes. I don't know whether our highly levered economy can absorb 5 rate hikes so quickly.
Right. Again, tons of great questions. One is, how does one think about the relative sensitivity of this economy today to interest rate hikes and monetary contractions? It's so easy to forget. The balance sheet is 10 times bigger than it was pre-2008. You know, that's absolutely wild, 1,000%. But you mentioned the 1970s, and that you're saying you don't think we'll see inflation like that. But we are seeing one similar to what we had in the 70s, which is rising energy prices. Do you not foresee the possibility that energy prices could get out of control, similar to how they did in the 70s, especially given some of the explicit policy choices and ESG mandates that have been adopted by Western governments and corporations in recent years?
So that's a really complicated question because lots of things have driven energy prices. But let me focus on a crucial point you just raised, is that the transition to a greener economy, to a more sustainable economy, is proving to be more complicated than we expected. And I think that this is showing us that it's not enough to agree on the destination. And I am absolutely committed to the destination of a more sustainable way of doing things. I'm absolutely committed to the war against climate change. But whenever you embark on a journey, it's not enough to say, I'm going towards a destination without spending time thinking about the journey. And it turns out that we didn't think enough about the journey. that we didn't realize you cannot substitute something with nothing. So we started the transition away from particularly polluting energy sources, and that is a good thing. But we didn't have the green energy available in enough magnitude. Because of that, gas and oil in particular, that are now being treated as transition energy sources, have seen their prices go up a long way. Now that causes two things. One is stagflationary forces, but that doesn't impact the destination. It just means the journey becomes less pleasant, but it also can erode political will. And already we've seen certain countries in the developing world reopen coal mines to try and deal with this energy surge. And that, the more people do that, the more you lose political will, the more the destination becomes more elusive. So, keep an eye on energy. It's really important. The first effect, the stagflationary force, will play itself out because people get priced out of energy-intensive activities. But the second effect is one that you really have to keep an eye on.
All right, so let's switch back to geopolitics because that actually does relate to energy. It relates specifically to the cost-benefit analysis that leaders make in a multilateral framework versus one where individual countries have concern for their national best interest and specifically their national defense. How do you think that changing expectations on the part of global leaders will manifest in terms of shifting alliances, bilateral agreements, and other forms of diplomacy and military buildup in Europe and Asia, and in particular in Europe, where you've got these security trade-off that has happened ever since the dawn of the Cold War, where the Europeans have basically offloaded their security to the United States. And that has also given them the luxury to be able to come together in the form of the EU, which itself is a sort of, one questions the viability of that system.
So for a long time, countries ran what I call a dual option model. You had an option on the US for national security, and you had an option on something else, the EU, or more recently, China. So let's take the example of Australia. Australia is a member of the Five Eyes intelligence system. That is the US, Canada, UK, New Zealand, and Australia. That is the highest level of national security coordination. So Australia had an option on the US for national security. It also was pursuing links with China in order to pursue economic prosperity. That's the dual option model. And it was worked very well. In option pricing terms, the price of that option was very, very low. As US-China tensions build up, the price of that option becomes much more elevated. And at some point, as de facto happened in Australia, you are asked to make a choice. And believe me, the last thing these dual option countries want to do is make this sort of choice. So the first thing is to recognize that this dual option model worked fine when it was US and Europe. The US would stand by and let Europe pursue its ever closer union because that was viewed actually as enhancing the national security of the continent. But it's very different when it comes US-China with all the complications of that relationship. That is the first major change in the way the system operates. But there's another change that I think we should not underestimate. Coming out of World War II, we constructed a global system where the core, basically the US and Europe, were given massive privileges, and two in particular. The issuance of the reserve currency, which means that you give pieces of paper to the rest of the world and you receive goods and services. That's a great deal. And the second thing is that countries outsourced to the US and to Europe the management of their savings. So the US and Europe ran with a much higher level of savings than they would otherwise, which meant that their interest rates were lower than they would otherwise. Add to that the US and Europe were given enormous power at the multilateral institution. Even today, the head of the World Bank is an American, the head of the IMF is a European. Even today, Europe and the US, with one or two other countries, can block major decisions at these organizations. Now, that system works well if together with these privileges comes responsibility. And that is the implicit contract that the rest of the world had with this system. The core is privileged, but the core is responsible for the well-functioning of the system. And to the extent that you have volatility, the Russian crisis, the Asian crisis, the Mexican crisis, the Argentinian default, they all happen in the periphery. 2008 was a great shock to that system because the crisis originated in the US. 2017 was another shock to this system because under President Trump, the US pivoted very suddenly to an America First model. And then today, there's a third shock to that system, which is that the Federal Reserve is in the midst of making a policy mistake. And that is the world's most powerful central bank. So the other thing that's happened to our global system that has made it less stable, more fragmented, that has made multilateralism much harder to pursue, is that the implicit contract itself is trusted by fewer people, or at least is not trusted as much as it was before.
So what does that mean for the position of the dollar? And also, what does it mean for other, let's say, currency like either foreign currencies of an emerging country like China, which, of course, obviously the Chinese yuan cannot replace the dollar, at least not today. And there still doesn't seem to be any good alternative. But also, what does it mean for something like gold or, let's say, cryptocurrencies, which have been huge beneficiaries of the risk-on trade, but which, interestingly enough, have this quality that's different than any other asset class that I can think of in recent memory, which is that so much of the narrative that has driven their valuation has been political in nature. It has been a bet against governments, a bet against central banks. So how do you think of that?
So it's really important to remember that when it comes to a reserve currency, when it comes to the dollar, you cannot replace something with nothing. So you have to be able to identify what is it that's going to replace the dollar. No other national currency has the attributes of a dollar. So if your world is limited to simply national currency, you end up in a situation where the dollar is the cleanest dirty shirt. What do I mean by that? Assume you are on a business trip and you really are a good packer and you've packed exactly for the duration of that trip. And then suddenly your trip is extended and you don't have time to go to the laundry. That morning, you will look at what you have in your closet and you will wear your least dirty shirt or blouse. And that's what the dollar is. The dollar is not perfectly clean, but it is cleaner than anything else. So whenever I hear that the Chinese currency is going to overtake the dollar as a reserve currency, I think, you know what, that's going to take decades. Along comes crypto. Crypto is very different. Crypto is underwritten by an innovative technology. It has a bunch of people that are fundamentalists for the reasons you've cited. They love the notion of a currency operating outside the government system. And their steadfast adoption of that currency has encouraged other people to start adopting it. So will that be the end of the dollar? The answer is no. I'm not a believer that crypto will disappear, but I am a believer that crypto will not become the world currency because governments will fight it. They will fight it because it complicates monetary policy. It takes away the seigniorage that you get from issuing a currency, and are legitimate concerns that the good of blockchain technology and the broader good of fintech and other innovation comes also with increased risk of malfeasance, illicit payments, etc. So this notion that we should expect governments to stand by on the sideline and cheer crypto on is not going to happen. And we've seen two reactions. China, very clear. Make it almost impossible for the private sector to develop their own alternative currencies, but co-opt the technology and start working on a central bank digital currency, CBDC. The US, unfortunately, is still trying to sort out, does it want a private model, does it want a public model? And the two sides aren't talking to each other enough. They should be. They really should be, because this innovation is not going to disappear. But in neither cases is crypto a global currency.
Does that also mean that you think that regulations will distinguish or differentiate between certain types of protocols that, let's say, generate utility versus ones that are focused on being currencies like stablecoins or something like Bitcoin, for example, which was recently adopted in a certain way by the government in El Salvador?
So I do think that we're going to have refined regulation. I do think that people are going to recognize that this is an incredible heterogeneous space, that it's not just Bitcoins, that there is an enormous amount of things to look at, and we will get differentiated regulation, but it's going to take time. Right now, the two sides are speaking different languages. The crypto fintech industry risk repeating the mistake of big tech, which is you are so focused on the incredible innovations and the things that you're able to do that you weren't able to do and the efficiency gains that you lose sight of the systemic implications. And by the time you realize you're systemically important, it's too late to do something about the unintended consequences and collateral damage of your activity. That's what has happened with big tech. Governments, on the other side, are also repeating the same mistake, which is of not engaging early enough and with an open mind enough to understand how powerful these innovations are. So hopefully the two sides will talk to each other more, because there are significant efficiency gains to be made to all sorts of financial transactions. And it needn't be a global currency, but it can be really impactful in terms of the payment system, remittances, and all sorts of other issues that right now are rather inefficient in the financial system and are costing too many people too much money, including, unfortunately, the most vulnerable segments of our population.
Mohamed, you've been so generous with your time. We had some technical difficulties that caused you to drop off during the call. One last question, if you could answer this, which is, given everything that we've talked about today and your views on where the market is going and the risks, or maybe a better way to put it is the risks and how to position, how do you think about positioning yourself, and what are the industries and national economies and regional economies that you think are best positioned to handle the type of regime that we're moving into?
So I think of three simple frameworks to apply. And when you solve for your own risk tolerance and investment objectives, you get answers. One is the ratio of tactical positioning relative to structural positioning relative to secular positioning. Tactical is something that you believe in for now, but you have your eyes wide open to things changing. Riding the liquidity wave is an example of tactical. Secular is something that's going to work up over time, but it will be a bumpy process. And then structural is because you are taking advantage of some inefficiency in the system, investor segmentation being one example. So the first thing is be very clear as to how you are positioned. And right now, you want to emphasize structural and tactical over secular because the world is uncertain. The second is understand the importance of mistakes. Mistakes are mostly recoverable in the investment world. If you have time and you're not forced out of your positions and you don't have a default, most mistakes are recoverable. There are unrecoverable mistakes. And you require a tremendous amount of granular analyses, an understanding of where are you in the capital structure, how are you collateralized or not collateralized, who else is sitting in the table with you. And you just have to recognize whether if you end up making a mistake, and we really don't want to make a mistake. No one wants to make a mistake. But when the world is uncertain as it is today, the probability of mistake goes up, that you have contained and eliminated your unrecoverable mistakes. And then the third issue is, what attributes do you want during both the journey and the destination? For example, today, you would want, wherever you invest, to have pricing power. Pricing power is really important in a world facing inflationary pressures. And that comes down to the last issue, is that sort of determination comes from a mindset that has three things. One is resilience. If you fall down, you pick yourself up really quickly. You don't have to deal with all the consequences of falling down. Two is optionality. You keep your mind open. You look for data. You revisit your priors. And the third one is agility. Is the confidence to move forward even after you've made a mistake. And hopefully, if you have resilience, then that mistake is not too costly.
Mohamed, thank you so much for your time. I really appreciate having you on. Thank you.
It's my great pleasure. Thanks for the great question and the interesting discussion.
For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.